What if building wealth was far simpler than you've been told? In The Simple Path to Wealth, J.L. Collins gives you the no-nonsense roadmap. Avoid debt, save aggressively, and invest automatically in broad market index funds. This Insibook summary cuts through the noise so you can build freedom, without day trading, hot tips, or stress. Let's simplify wealth. The journey toward financial freedom often feels overwhelming, tangled in a web of jargon, complex strategies, and conflicting advice. Many believe wealth building requires intricate knowledge, constant monitoring, and a tolerance for high-stakes gambles. But what if the path wasn't just simple, but profoundly simple? What if the most effective way to build lasting wealth was accessible to anyone willing to adopt a few core principles and stick with them, regardless of market noise or conventional wisdom? This is the essence of the path revealed, a journey focused on clarity, consistency, and a deep understanding of how money truly works for you. It begins with a fundamental shift in perspective, defining what you truly want. For many, the ultimate goal isn't just accumulating numbers in an account, but achieving a state of genuine freedom. This freedom means having enough resources that you are no longer compelled to trade your time for money just to survive or maintain a certain lifestyle. It's the ability to make life choices based on desire, not necessity. It's the power to say yes to opportunities that align with your values and passions, and no to obligations that drain your spirit without financial fear looming over you. This isn't about luxury yachts or mansions, necessarily, though it can certainly accommodate them. It's about autonomy. It's about having enough financial cushion, enough FU money, as it's sometimes called, to control your own destiny, to walk away from bad situations, whether it's a job you dislike, a toxic relationship, or simply the need to take time for yourself or your family. This control is the true prize. Achieving this level of independence hinges on a surprisingly straightforward equation. Live below your means and save the difference. This isn't revolutionary advice, but its importance cannot be overstated. It is the absolute bedrock upon which all lasting wealth is built. If you spend every penny you earn, or even more than you earn, no amount of investing skill or market timing will save you. You must create a surplus. This means consciously managing your expenses, distinguishing between needs and wants, and making deliberate choices about where your money goes. It requires tracking your spending, understanding your cash flow, and finding ways to reduce outlays without necessarily sacrificing quality of life. Often, reducing consumption leads to greater happiness anyway, freeing you from the endless cycle of desiring more possessions and focusing instead on experiences, relationships, and personal growth. The gap between what you earn and what you spend is your potential for wealth creation. The wider you can make that gap through disciplined spending, the faster you can build the resources needed for true financial independence. Once you have established the habit of living below your means and consistently saving a portion of your income, the next critical step is to make that saved money work for you. Simply hoarding cash, while seemingly safe, is a losing game in the long run. Inflation, the silent thief, steadily erodes the purchasing power of money sitting idle. Your savings need to grow at a rate that outpaces inflation, and ideally, significantly exceeds it, to build real wealth. This is where investing comes in. However, the world of investing is often presented as a complex minefield. You're bombarded with advice about stocks, bonds, mutual funds, ETFs, real estate, commodities, options, futures, and a dizzying array of strategies. Growth investing, value investing, dividend investing, day trading, swing trading. It's enough to make anyone's head spin, and often serves more to confuse than to clarify. The truth is, you don't need to be an expert trader or a financial analyst to build substantial wealth. The most effective approach, counterintuitively to many, is the simplest one. Forget trying to pick the next hot stock or time the market's movements. These activities are largely futile, incredibly time-consuming, and often lead to worse results than simply staying invested. Instead, focus on a strategy that harnesses the power of the overall market and the relentless force of compounding returns over the long term. The key lies in understanding what drives long-term market growth. Historically, despite short-term volatility and occasional crashes, the stock market as a whole has delivered consistent, positive returns. This growth is fueled by the innovation, productivity, and expansion of businesses worldwide. Why try to bet on individual horses when you can own a piece of the entire racetrack? This is the core idea behind investing in broad market index funds. An index fund is a type of mutual fund or exchange-traded fund, ETF, with a portfolio constructed to match or track the components of a financial market index, such as the S&P 500 or the total stock market. By investing in a single, low-cost, total market index fund, you instantly gain diversification across hundreds, even thousands of companies. You're not betting on one company succeeding. You're betting on the overall success of the economy. The advantages of this approach are numerous and profound. Firstly, costs matter enormously. Actively managed funds, where managers try to beat the market by picking specific stocks, charge significantly higher fees, expense ratios. These fees, even seemingly small percentages, compound over time and act as a massive drag on your returns. Index funds, designed simply to track an index, have incredibly low expense ratios. This means more of your money stays invested and working for you. Secondly, studies consistently show that the vast majority of actively managed funds fail to outperform their benchmark index over the long term, especially after accounting for their higher fees. By choosing an index fund, you guarantee yourself the market's return, minus minimal costs. You eliminate the risk of picking a fund manager who underperforms, and you capture the growth that drives wealth creation. The specific vehicle often recommended is a fund that covers the entire U.S. stock market, like Vanguard's Total Stock Market Index Fund, VTSAX. This single fund gives you exposure to large companies, medium-sized ones, and small ones, encompassing growth and value stocks across various sectors. It's the epitome of diversification in one place. For international exposure, adding a total international stock market index fund, like VTIX, creates an even broader, globally diversified portfolio. This two-fund or even one-fund approach is simple, effective, and requires virtually no active decision-making beyond the initial investment and subsequent contributions. The philosophy is one of unwavering buy and hold. Once you've chosen your low-cost index fund, the strategy is to buy them and hold onto them for the long haul. You don't sell when the market drops, you don't panic sell during a recession, and you don't try to jump in and out based on predictions. You simply keep buying regularly, ideally through automatic contributions from your bank account or paycheck. This strategy leverages the power of dollar-cost averaging, investing a fixed amount of money at regular intervals, which naturally buys more shares when prices are low and fewer when prices are high. It also aligns perfectly with the exponential growth potential of compounding. Compound interest is often called the eighth wonder of the world because it allows your investment returns to generate their own returns, leading to exponential growth over time. The longer your money stays invested, the more powerful compounding becomes. Starting early is therefore a significant advantage, giving your money more time to grow exponentially. Understanding and managing your emotional response to market fluctuations is perhaps the most challenging yet crucial aspect of this simple path. Markets are inherently volatile. They go up and they come down. Sometimes they drop sharply and unexpectedly. News headlines will scream about impending doom. Financial pundits will predict crashes, and your own gut instinct might scream at you to sell and protect your capital. This is where the concept of Mr. Market, a metaphor borrowed from Benjamin Graham, becomes invaluable. Imagine your portfolio is owned by a manic-depressive business partner named Mr. Market. Every day, he shows up with a different price at which he's willing to buy your share or sell you his. Sometimes he's euphoric and offers a ridiculously high price. Other times, he's despondent and offers a very low price. Your job isn't to react to his daily mood swings or try to predict them. Your job is to take advantage of his low price offers when you have cash, by buying more, and to ignore his high price offers when you don't need to sell. If you need to sell, you might consider his offer, but you should never feel compelled to sell just because he's offering a high price today. More importantly, you should never sell in a panic just because he's offering a low price. By developing emotional resilience and focusing on the long-term plan, you can weather the inevitable downturns and benefit from the eventual recoveries. This steady, unemotional approach allows the power of compounding and market growth to work its magic uninterrupted. Practical implementation involves utilizing investment accounts effectively. Taxable brokerage accounts are straightforward places to invest, but the gains are subject to capital gains taxes. More advantageous are tax-advantaged retirement accounts. In the US, this includes accounts like the 401k or 403b, often offered by employers, and the Individual Retirement Account, IRA, which individuals can open themselves. Many employers offer a matching contribution to their 401k plans, free money that you should absolutely take advantage of by contributing enough to get the full match. These accounts offer significant tax benefits. Contributions to traditional 401ks and IRAs are often tax-deductible, lowering your taxable income today, and the investments grow tax-deferred until withdrawal in retirement. Roth versions of these accounts, Roth 401k and Roth IRA, involve contributing after-tax dollars, but qualified withdrawals in retirement are completely tax-free. Understanding the specific rules and benefits of these accounts is important for maximizing your investment efficiency. A common strategy involves maxing out tax-advantaged accounts first, especially if there's an employer match, before investing further in a taxable account. The choice between U.S. total market funds and international total market funds often comes down to a simple ratio. Many find a portfolio weighted perhaps 70–80% in U.S. stocks and 20–30% in international stocks to be a reasonable starting point for global diversification. But the precise allocation is less critical than the commitment to the strategy itself. The key is that both components are invested in low-cost, broad market index funds and held for the long term. As your wealth grows, you'll reach a point where your investments generate enough income through dividends, interest, and capital appreciation to cover your living expenses indefinitely. This is the state of financial independence. At this point, you are no longer reliant on a paycheck. You can choose to continue working if you enjoy it, switch to a less demanding or more fulfilling career, start your own business, volunteer, travel, or simply enjoy your time without the pressure of earning a living. The money you've accumulated acts as a buffer, providing security and enabling you to pursue what truly matters to you. The beauty of this simple path lies in its accessibility and its robustness. It doesn't require genius, luck, or sophisticated financial maneuvering. It requires discipline, patience, and a willingness to ignore the noise. It's about understanding that consistent, long-term investment in a diversified portfolio of low-cost index funds is the most reliable way to build wealth. It's about recognizing that market volatility is not a sign of impending disaster, but a normal characteristic of investing that can even be an advantage if approached with the right mindset. It's about automating the process as much as possible, setting up automatic contributions, choosing investments you don't need to actively manage, to remove emotion and friction. Think about the cumulative effect, saving 15–20% of your income, living below your means, and investing consistently in a diversified index fund portfolio that earns an average historical market return, say 7–10% annually, over several decades, can transform modest savings into significant wealth. The power of compounding works like a snowball rolling downhill, gathering momentum and size the longer it rolls. $1 invested today could be worth many times that amount decades down the line, entirely due to reinvested earnings generating further earnings. This path also frees you from the burden of constant financial decision-making. Once the core strategy is in place, live below your means, save consistently, invest in low-cost total market index funds, and hold for the long term, the day-to-day management becomes minimal. You check in periodically, perhaps quarterly or annually, to ensure you're on track and to rebalance slightly if needed. Though with a simple 2-fund portfolio, this is often unnecessary. But you don't need to agonize over daily market movements. This frees up mental energy and time to focus on other aspects of life, relationships, health, hobbies, contributing to your community. Furthermore, the philosophy extends beyond mere accumulation. It's about building a life of purpose and fulfillment, using financial independence as a tool, not the end goal itself. Wealth provides options. It allows you to weather unexpected storms, like job loss or medical emergencies, without derailing your life. It enables you to support causes you believe in, help family members, or pursue entrepreneurial ventures without the immediate pressure of needing to generate income. It shifts your relationship with money from one of necessity and obligation to one of freedom and choice. The simplicity is deceptive. It sounds almost too easy, But the difficulty lies not in understanding the strategy, but in executing it consistently, especially when faced with the emotional challenges markets present. It requires trusting the process even when it feels like nothing is happening, or worse, when the market is declining sharply. It means resisting the urge to chase hot trends or follow the advice of those promising quick riches. It's about adopting a long-term perspective that spans decades, not days or months. Consider the alternative: trying to actively trade stocks, timing the market, or picking winning mutual funds. This requires constant research, emotional discipline of a different kind, often leading to mistakes, and usually results in lower net returns due to fees and poor decision-making. The simple path avoids all of this complexity and risk, providing a high probability of success for anyone willing to stick with it. It's a path built on data, historical performance, and a deep understanding of how markets and human psychology interact. So, the core tenets are clear: save diligently. Make saving a significant, non-negotiable part of your budget. Live below your means to create the surplus needed. Eliminate high-interest debt. Debt is a major obstacle to wealth building. Pay it off aggressively. Invest consistently. Put your savings to work in the market. Embrace simplicity. Use low-cost, broad market index funds as your primary investment vehicle. A total U.S. stock market fund and a total international stock market fund are often sufficient. Buy and hold. Commit to holding your investments for the long term, regardless of market fluctuations. Control your emotions. Understand that volatility is normal. Don't panic sell during downturns or chase performance during upturns. Treat market declines as opportunities. Utilize tax-advantaged accounts. Maximize contributions to retirement accounts like 401ks and IRAs to benefit from tax deferral or tax-free growth. Be patient. Wealth building is a marathon, not a sprint. Trust the process of compounding and allow time to work its magic. By focusing on these principles, you sidestep the complexities and pitfalls that derail so many financial plans. You build a foundation that is resilient, effective, and most importantly, achievable. The ultimate reward is not just financial wealth, but the profound sense of security, freedom, and control over your own life that comes with it. It's about building a life you love, on your own terms, powered by a simple, reliable, and proven path. This clarity empowers you to move forward with confidence, knowing that the tools for achieving financial independence are within your reach, requiring only discipline and persistence. The journey unfolds one saved dollar, one consistent investment, one calm reaction to market news at a time, ultimately leading to a future defined by choice, not by financial constraint.